Hey everyone, thank you so much for being here. Before we kick off this week's episode, just a quick ask. Please don't forget to like, subscribe, hit the notification bell to make sure that you never miss an episode, never miss out on any of the strategies and tactics that we're sharing to help you continue charting your own path to freedom. And if you'd like to go deeper with any of this, we've launched a free Facebook group, which you can join at pathtofreedom.com/group. And we've linked that in the show notes to make it easy for you to find. All right. Thank you again for being here. Let's drop in to the episode. Hey, everyone, and welcome back to another episode of the Path to Freedom podcast. And I'm just now realizing I should have asked this before we started recording, but my guest today is Randy, and I'm going to take a stab at pronouncing his last name, and hopefully I don't butcher it too bad, Randy. It's Langenderfer. It's probably not it at all.
Langenderfer. You were 99% there. Langenderfer.
All right. Not too often that I have someone with a longer last name than mine on the show. But Randy, it's great to have you. I appreciate you being here and really look forward to the discussion today.
Hey, Wes, the privilege is all mine to be on your show, man. I just really appreciate the opportunity and looking forward to hopefully shedding some value with your listeners.
Yeah, well, I know you will. We had a chance to chat a little bit very recently, and there were some great takeaways for me. You're an expert in an area that I'm personally very interested in learning more about. I've dabbled a little bit in real estate investing, but am certainly not an expert myself, and it's absolutely something that my wife and I want to do more of going forward. And so we'll get into a little bit of your story and what your company that helps others invest in real estate, along with you investing yourself in real estate, how you go about it today. But it sounds like you've done a lot of different types of real estate investing over the years, and you've kind of narrowed in on a particular way of investing in real estate that you like and has worked well for you. And so I think, just hearing from you kind of not only how you go about it and help others go about it now, but also what you've tried in the past and why you've ended up going the direction that you have will be really helpful, because I think a lot of people are probably similar to me in that they understand why real estate investing, can be such a good strategy for, building wealth and creating additional income streams. But there are so many different ways to go about it. And, it can be pretty overwhelming for the amateur or novice real estate investor to even know where to get started. So again, really excited to have you here and learn a little bit from your expertise. But, with that, tell us a little bit. So you're the principal of InvestArk. That's your company today. So tell us a little bit more. What is InvestArk and how do you guys go about investing in real estate?
Well, I got to tell you, that is probably one of the best intros I've seen or heard in a long time. Thank you, sir.
Well, hey, I'm just, I've been drinking since noon. So sometimes I'm just kidding. I've not been, that was a joke, but no, it's, to me, this is why it's interesting. And, this is what I'm excited about learning from you today.
Well, yeah, and thanks. And we've just recently got acquainted, and I've looked back at some of your podcasts on franchising, which equally intriguing to me, as you know. But Randy Langenderfer, Houston, Texas today. I'm a native of the Midwest, specifically Cleveland, Ohio. Came down here 10 years ago for business purposes. And really today, I sit here today as what we'd call a multifamily syndicator. Yeah. And solely today, I look at finding large deals, commercial real estate, and more specifically apartment buildings, large apartment buildings, to identify to buy and find investors that would go along together, forming a syndication. Syndication is nothing more than a group of investors that go together and buy something big that none of us could buy together. So
right.
I've been focusing on that migration for about 10 years. And I started out in the single family space, flipping houses. And I was a hard money lender. And that was productive. but I found that it became very, very time consuming. And I had a W-2 job at the time, and just really to scale that business became very difficult. And so I settled in on multifamily syndications and been investing in myself in terms of my own money and my own education for the last 10 years, and hopefully bringing value to investors and making money along the way.
Can you explain what a hard money lender is? We'll get right back to the episode in just a minute, but if you've been considering business ownership, if you're already a business owner looking to expand and you're curious about franchising, I'd love to connect with you, answer any initial questions that you have, talk about a specific franchise, and detail the exact process that I use and have taken hundreds of people through to help them understand franchise ownership, find the right franchise for them, and conduct the necessary due diligence. Click the link in the show notes if you'd like to schedule a free, no obligation strategy call. I look forward to talking with you. And now back to the episode.
Very simply, a hard money lender is the bank. So I was living in Cleveland, Ohio at the time, and we would lend money to a group in South Florida, Dade County, who would buy the home and make the repairs and then sell it. And so we would take a hefty interest rate and for the money that we lent them. So it was easier for them to do it that way than to get money through a bank, because a bank will slow down the construction and the rehab withdrawals and paperwork, where their whole goal is to get in and get out and sell it quickly.
Yes.
So that's really their venue for a hard money lender. And for us, it was a profit motive.
Got it. Okay. So that's how you got into doing flips with single family homes. You were not, I guess, personally buying the house and overseeing the flip, right? Yeah. You weren't swinging hammers or climbing ladders. You were lending money to a specific group of people that were handling that aspect of it.
Yeah, they would find properties that they liked. They would send them to us. They'd have to show us comps in a 1 mile, 3 mile radius. They'd have to show us what the repair budget was going to be, how much it was going to take to rehab the house. And we would challenge all of those assumptions a lot. And once you gain comfort with all that of where it's at. And so that was the time consuming pieces. Every new house is in a new area. And we were looking at Dade County, Miami Beach, but huge metro area, and as you know, location in real estate. Yeah. So it came really challenging just to look at the comps and what it was. And then, flippers tend to have a skinny repair budget that sometimes works out and sometimes doesn't. So you really want to make sure that happens and gain comfort with that. So you gained comfort with the volume and their assumptions and the relationship. And then it became fruitful, but long lead up. But to do that 60 times or 70 times is mind numbing. It takes a big team.
Yeah, I imagine. It takes a big team. And there's just so much that can go wrong, when you're rehabbing a house. We owned a insulation business, and we did a lot of new construction and worked with contractors that were doing remodels. And one of my big takeaways from that business was it doesn't matter how much you plan and how prepared you are, something's going to go wrong and change those plans. It's almost inevitable in that type of work. So that's kind of how you got started in real estate. As you've already mentioned, you eventually pivoted to, what you're focused on today, which is multifamily, primarily apartment complex, through these syndications. So I definitely want to talk about that, because that's something I do have a little bit of exposure to and am very interested in learning more. But let's back up first. So what was it that drove you to start, really looking at different ways of investing in real estate? You mentioned that you ended up in Texas for a job. You had a W-2 back when you were, starting to get into some of these single family flips and the hard money lending. What was kind of the driver and how did it all start for you?
Yeah, thanks. And that's a very kind of a personal story, but happy to share it. So, it's the flipping business made it easy because coming out of the '08 and '09 recession, everybody remembers there just were many, many defaults. And so it was very easy to pick up houses and at 60 or 70 cents in the dollar and rehab and flip them. That grew out of vogue. And so the cause for me was I was at the time working for a private equity company in Cleveland, Ohio, a Carlisle-based company, a very famous and prestigious private equity company. And
Yep.
coming out of '08, '09, I was very concerned that I was going to lose my job, my W-2 job. I was an executive making a healthy buck and a single incomer. My wife was a stay at home with the kids.
Yep.
And that was extremely motivating to me to realize that, gosh, I could be on the streets.
Yeah.
And at the income level I was at, I wasn't going to find a job readily in that economy.
Yep.
So it was just a real aha moment that I had reached that season of life in the corporate world where I needed to find another wall to lean my ladder on, as they say. And I started looking at a lot of different things. Primarily, I was focused on trying to identify another income stream, as we said. And so I was looking at buying a business, a small business. I did look at a couple of franchises, but they were really expensive and out of my league financially. And that's just when I kind of fell into real estate with a brother-in-law who had gotten laid off from a large regional bank. And
Okay.
he told me about flipping, and I said, "You're crazy. You're crazy." And he got me comfortable with it over a period of time. And so then when I moved to Texas, I got real excited about real estate because Houston's the fourth largest metro in the U.S. And I figured this would be like gravy to find houses to flip in
Yeah.
Houston. And I did it for a while down here when I first came. But that's when I sat in on a multifamily a real estate seminar and heard about multifamily. And I tell you, the real kicker for me, Wes, was when I looked at buying businesses, a lot of things that I had to sign a personal note on,
Yeah.
guaranteeing the loan. And I learned in multifamily that I can buy a multi-million-dollar asset on a non-recourse loan, meaning that I don't have to sign personally for it. The loan is guaranteed by the asset, not by my income or my net worth. And I really didn't want to leverage what little I had saved and earned in that period of time. So that
Yeah.
was a real attraction for me to get interested in. So
Yeah. It's a big
that's the starting
differentiator.
point.
When you kind of compare real estate to, something like buying or investing in a business. And, I have quite a few conversations with people that are, kind of like it sounds like you were at this point in time, just evaluating a number of different options, trying to figure out, what was going to be the best move for you. So I talked to quite a few people that are, either considering investing in real estate or they've already done some of that and they're weighing the possibility of investing in like a franchise compared to that. And there's some pretty stark differences. And I've kind of seen that, especially people that have done well investing in real estate, the idea of going and starting a business can be a tough pill to swallow, which I totally get. I mean, some of the reasons that you mentioned, there's also
Yeah.
the time component. I mean, as we've already established, there's numerous ways to invest in real estate, but some of them, especially through like a syndication, it's entirely passive, right? And one of the things I constantly have to
Right.
remind people of when we're talking about franchise businesses is, look, it's never going to be passive. It's never going to be entirely passive. And there's different ways
Right.
that someone can get into owning, a franchise business, and they do not all necessarily require the franchise owner to be full-time in the business, right? It's very possible for someone to maintain a W-2 job that they have and start a franchise, if they have the right skill set and if the job has
Yeah.
enough flexibility to where they have the bandwidth. But anyways, the point is, I think, it's important for people to understand that, and it doesn't, we don't have to just talk about franchises either, right? At the end of the day, if you own a business, it is never going to be entirely passive, right? You ultimately are the one that's
Correct.
responsible. The buck stops with you. So I think that's another reason that real estate is so interesting for me personally. I know a lot of other successful business owners that are also real estate investors, because most people, unless you're Elon Musk, right, or someone that's wired like him, a couple of businesses is probably about as much as you're going to have the bandwidth to oversee. And if those businesses are doing well, then hopefully you've got good income, good cash flow. You need smart ways to put that money to work,
Yeah.
but that are not going to require so much of your time. And obviously there's the stock market and retirement accounts and things like that. But I think especially people that are entrepreneurially minded are usually looking for something a little more outside of the lines than, hey, I'm going to put this money into a 401k and let it sit there until I'm sometime in my 60s and then pull it out.
Yeah, you're absolutely right. I mean, if you look back, at the history, I can only think Warren Buffett is the only guy. I'm sure there are more. Warren Buffett's the only guy that comes to the top of my mind who have made a fortune off of investing in the stock
Nancy
market.
Pelosi's done pretty well, it seems.
In the stock market, okay.
Yeah.
I know her husband has a business though.
Yeah.
And Nancy's
No,
probably
that's
got a few.
just that I've seen people online tracking her along with other like senators and Congress members tracking their stock trades, and many of them have records that are better than Warren Buffett's. So the running joke is like, obviously they're privy to information that the rest of us are not. But anyways, I digress from that. But yeah, I mean, and
I was just going to say, so yeah, I was going to avoid that political conversation, but I get your point. But the point of it is the real estate is, so many have done it before me, and I have a mentor tell me, Randy, just follow the playbook. It's just follow the playbook. Don't deviate until you've got many deals underneath your belt. And so there's so many aspects of real estate, as you said. I mean, there's single family, there's multifamily, there's other asset classes, there's buy and hold, there's flips. And the reason I got attracted to this is because it's scalable. It's passive. I started out as a passive investor. I invested in other people's deals to learn the business, and I still do that today. And then I became a general partner, or active investor, which is now I'm finding deals, and so I'm spending a lot of time on it. But the simple illustration, Wes, that somebody gave me, it's the example of the pilot in the front of the airplane versus the passenger. The pilot is the active, or the GP. He's got to worry about the weather and ground control and the behavior of his passengers and mechanical failures. And the passenger is just sitting back in first class or in economy, sipping their favorite beverage, enjoying the ride.
Yeah.
You can be either in real estate. You can be either. And I find there's a lot of corporate people that I talk to as investors that were like me, that are looking to diversify, because I grew up with the paradigm of stocks, bonds, mutual funds, etc. And I have advanced degrees. I'm a CPA and an MBA in finance, and I won't say that's bad, but I think I talked to a lot of people about diversification. So my previous employer here in Houston was a large academic medical center and had $2 billion in an endowment. And anywhere between 8 and 12% of that was in real estate.
Yeah.
So they don't teach you that in grad school.
When you mentioned Warren Buffett, I mean,
yeah.
he's done a lot of investing in real estate.
He has. Yeah. And so you can get into a syndication fairly easy. You just have to find the right person and the property that you like. And it can be, passive income to you, where you're getting a healthy return. I mean, the four reasons you look at commercial real estate, are: one is because of the favorable tax treatment; two, forced appreciation, where because businesses in real estate, commercial real estate, is evaluated based upon the cash flow it generates. It's
Mm-hmm.
not like your primary residence, which is based upon the comps. So the
Yes.
more cash a property generates, the more it's worth. Doesn't matter where it's located. It could be located in the hood. If it's generating a lot of cash, it's worth a lot. So forced appreciation, favorable tax treatment, positive cash flow
Mm-hmm.
are the three really big reasons why people invest in this. And
Yeah.
I think there's
Yeah.
just more people ought to try and understand it.
Yeah. I mean, to me, it makes a lot of sense. And I think in this day and age, more and more people realize the importance of having multiple income streams and investing in a variety of different cash flowing assets, or at least appreciating
Yeah.
assets. You know, my wife's father, who is 88 years old, he worked for the same company for 50 years, right? And retired and has a pension, and he followed that kind of playbook that you
Yeah.
reference, where he just put money into the stock market in retirement, and he's got his pension, and so, like, he's set up pretty nicely. But that's not the trajectory that really anyone is taking any longer, where they anticipate working for the same company forever. I mean, look at how many people are solopreneurs of some sort, or
Sure.
they do a variety of different types of um contractor type work, and instead of working directly for someone. So I think it's definitely more, is understood more at the mainstream level, why it's important to diversify. I think most people that are thinking about building wealth in any capacity, they understand real estate can be a great way to do that, but it's the getting started part that I think holds a lot of people up. And so, what was it? I know you've touched on this a little bit. When you started with multifamily, it was truly passive for you because you were investing in other people's deals. What were some of the other reasons that over the years you've really kind of just narrowed in on multifamily and moved away from
Yeah.
single family, flips? I mean, for the last 4 or 5 years at least, a lot of people have been preaching, short-term rental properties. Were you ever tempted to get into any of that? Like, what is it for you about the multifamily that makes it the best option for you?
One, and most importantly, it fits my personality, so I like it. So everybody's got to find that space that they like, and they're excited to let their feet hit the floor in the morning. But the reason specifically to me was starting out. I mentioned with non-recourse debt as an owner, I can
Yes.
buy a
Okay.
multi-million-dollar property easier than a kind of primary residence. I think the other thing that really intrigued me is in multifamily, I can have a 100-unit apartment building much easier than I can have 100 single family homes. And if I have a 100-unit apartment building and I have 10 vacancies, that's 10%. If I have one vacancy in a single family home, that's 100% vacancy.
Yeah.
And
Yeah.
so economies of scale is another virtue there of multifamily. Three is the first home my wife and I ever bought was a duplex. We lived in half and rented out the other half.
Mm-hmm.
And I swore I would never be a landlord again. So,
Yeah.
so so the other aspect of it is third party property management. So we
Mm-hmm.
hire professionals to run these assets. They deal with the tenants, the leasing, the maintenance, the complaints, et cetera. I don't have to deal with that.
Yeah.
Don't want to. So
That makes a lot
those
of
are
sense.
some really big ones for multi. And the other thing I would say is just the asset class of multifamily. There's primarily four classes of commercial real estate. So um, apartment buildings is the one we like. The other one would be commercial strip malls. I don't think
Mm-hmm.
so today. Office buildings. I don't think so. I wouldn't really want to invest in it. And the other one is industrial warehousing, which is booming. So of those, though, everybody needs a place to live. They may not need, an office building or a strip center, but everybody in America needs a place to live, and the government supports it with good debt terms because they realize that and want to support it.
Yeah. Well, and on top of all that, it seems like there's been this shift of more and more people renting than owning, whether that be an apartment or a townhouse or a single family home. But no, the way you break it out, it all makes sense, especially the economies of scale. I think a lot of people can probably appreciate not wanting to be a landlord and have that responsibility and the headaches that can come with that. And simply your point of, look, everyone does need a place to live makes a lot of sense. I think I told you, my wife and I had invested in a few units in a strip center, and this was back in 2020. We wouldn't have done it had we not known that we were going to turn around and lease them to our own businesses. Like I don't think we would have bought them if we were going to then just hope we could find someone to lease them out to, because they were both vacant when we bought them. So and then we sold those last year because I just didn't want to be a commercial landlord, and didn't think the likelihood of us finding a good long-term tenant at a monthly rent that made sense was going to happen anytime soon. So makes a lot of sense why you've kind of focused on multifamily. Kind of going back to when you started getting into real estate in the first place, it sounds like you were doing this just to really kind of hedge against the possibility of losing your job. At that point in time, did you imagine that it would turn into a full-time endeavor for you, and that it would kind of lay the groundwork for you to leave corporate America? Hey everyone, we'll be right back to the episode, but one quick note, success doesn't happen in a vacuum. So if you'd like to learn more, you want to go deeper and interact with like-minded people, I'd love to have you join the free Path to Freedom Facebook group. You can join by going to pathtofreedom.com/group and become a part of the Path to Freedom community. All right, back to the episode.
Yeah, I very consciously, Wes, very consciously 9 years ago made that decision and kind of commitment to this space. And as I'm benefited, as Lord blesses me, I'm going to turn around and maybe invest in some other classes. But I very consciously decided to become an expert in one area, versus the shotgun approach across many areas. And I very consciously did that and said, this is the space I want to perfect so that I can move away from the corporate world. And fortunate enough to say last March of 23, I finally took that leap and cut the purse strings and doing this full time. And, I love it. I never criticize anybody like your father-in-law. He's blessed. He's fortunate to work someplace 50 years. But like you said, there's no such thing as corporate loyalty, either from the corporation that there was in your father-in-law's day or from the employee side. My daughter works for a tech company in Seattle, and, people change jobs up there like they change restaurants. It's amazing. There's that paradigm is a 180-degree shift.
Yeah, it is. It's interesting because, as I have conversations with people that are considering business ownership, many of them are, gainfully employed, at a corporation of some sort or a company of some sort. And, the natural tendency is to think that, having a job with a salary and benefits and all of that is the less risky path than something crazy like going and taking your money or taking out a loan and investing it in real estate or investing it in a business. And, to your point, there's just no loyalty. And if you think about it, especially if it's a publicly traded company, right? It's the company's responsibility. It's their fiscal responsibility to do the best that they can for their shareholders. And so, that just inherently means that if it comes down to you as an employee or the bottom line, company chooses the bottom line every single time. And it's not always even necessarily like a nasty decision. It's just business, right? I don't think I've told you this story. Listeners of the podcast have heard it, but my wife was in pharmaceutical sales. She got into that right after college and did it for a while, and then Our oldest daughter, who turned 7 a few months ago, when my wife was out on maternity leave with our daughter, her company laid off 50% of the sales force across the US, and she was part of that layoff while on maternity leave. And she was a top producer. They had her on a management track,
Wow.
so it wasn't a performance thing. Like in this particular instance, they had drugs in the pipeline that ended up not getting the FDA approval that they needed. So she had been like prepping for months to go and start repping these drugs when they got the FDA approval, and something happened, and they no longer were going to have those drugs to offer. And so they had all these salespeople that they didn't need. So, and it sounds like, this is the case for you too, where, because I know for us, like looking back, it was one of the best things that could have happened to us. It sounds like this kind of fear,
Yeah.
concern that you had going back 9-10 years ago that drove you to start exploring other opportunities and learning real estate and deciding to specialize in one particular aspect of real estate investing. It turned out really well for you. For us, that's what prompted us to go and invest in our first franchise business. And fortunately, I'd been working in franchising for a few years at that point, so it was not a foreign concept to me. And I'd been selling franchises, right? So I've been helping other people get into business for themselves. So she and I had already been kicking around some ideas of, how we could maybe do something similar. She was on the fence about, really wanting to jump back into pharma sales, full time after just having our first kid. So one of those things that worked out for the best. In the time, it was pretty scary. But, I think both of those stories really just illustrate the fact that, the sooner you can start laying the groundwork, and it doesn't mean you have to go and leave your job. You sounds to me like you didn't end up losing your job. You went another 9 years keeping your job, but
Yep.
in the course of those 9 years, you became an expert in something. I'm sure you made some good money through your real estate investing over that time. You were able to set it up so that you could comfortably walk away from that
Mm-hmm.
corporate position and not have to um, struggle the way a lot of people do, I think, when they're wrestling with that type of a decision, or if it's forced on them.
Yeah, you're absolutely right. Whether it gets forced on them, in the illustration, I very consciously had an end date in mind with a circled on the date on the calendar, and got to get there. So how do I get there? And I always love the story of, I heard the person about passive income, the guy who, he was getting laid off, and he had developed a very nice passive income stream over the years, and his colleague didn't. And when the boss came in to tell the colleague that he was getting laid off, it was a big emotional thing. And when the guy who'd invested in passive income, the boss came in to tell him he was getting laid off, he said, "Would you like me to leave today?"
Yeah.
Because
Great. Can I go now? I've actually got a tea time that I can still make.
the point of it is he had options. That
Yeah.
person had options, had choices, and and that was just a very strong motivation for me of just saying, I wanted to work late in life. I didn't want to work 60 hours a week for the man. I wanted to work 40 or 50 for myself.
Yeah.
And that was just, today I sit and I enjoy, I still work a lot of hours, which is fine, but I work for myself and I work at my pace and when I want to
Yep.
work. And versus having to drive in traffic of Houston and fill out reports that are useless, et cetera, et cetera.
Yeah, it's a totally different feeling when you're working hard, but doing it for yourself and doing it on your own terms. And, look, at the end of the day, even if you're in a business that, gets you excited or you're passionate about, there's still going to be hard things that you'd prefer not to
Oh,
do. And, you're always going to have these tasks that, you just would rather not if you could avoid it. But it's so different when you're doing it for yourself and on your own terms. And I think a lot of people that are kind of wired, in that way, that actually drives them to work harder than, when they're doing it for someone else, and they kind of know how much they're going to make, whether they put in this amount of effort or, X amount more of effort. So at what point did you decide to set up your own syndication?
So I did my first passive investment in 2014. And I started after educating, and then I invested, and I've done several investments. And when I did my first general partnership, my first active, whatever you want to call it, either term's synonymous, opportunity arose. And again, it was the fact that I could do it while still employed.
Mm-hmm.
This business I wasn't going to be able to scale it as I'm trying to today, full employed, but I was able to do the first one. And so deal came across. A couple buddies asked me to join them to buy this asset in Beaumont, Texas, about 100 miles due east of Houston, between us and Lake Charles, if your audience knows that area. And it was the classic deal of what not to do, but what we did, and we learned a lot of lessons. And at the end of the day, we doubled investors' money after 21 months. So that's a home run as far as I'm concerned.
Yeah, if that was your example of, did a lot of things that you now know not to do, but still doubled your investors' money in less than 2 years, I would say that's pretty good. So I mean, I think because like I said, I've invested a little bit into, a multifamily syndication. I've looked at numerous of them. So I have I would say, basic understanding. I want to learn more about it. Some of the audience may be more familiar with it than I am. Some may not be at all. What does this look like for the passive investor into a typical real estate syndication, or the types of deals that you're putting together? What's kind of the minimum amount of money that someone would need to have and be willing to invest? And then, obviously you can't guarantee any certain returns or timeframes of those returns, but you are able to usually share some projections, right, with potential investors. Can you walk us through kind of what the return looks like, or could look like, for an investor, over the course of a couple of years, if they were to invest in one of these deals?
Yeah, I'd be happy to. So first of all, these are all what's called private placement offerings. So they're not available on the SEC, or on the Fortune 500. So they're all privately placed offerings. So they're not available. In other words, you have to know somebody like me, or other companies that do this. There's a lot of them out there. And so it's really important for your investors to track somebody. And we say, and I encourage your listening audience, if they're serious, to get to know, the keywords are know, like, and trust somebody. Somebody that you've had acquaintance with, that you've had conversations with. Once you know, like, and trust them, I'll just use myself for an example. I'm going to send you an investment summary of an investment opportunity. And it's going to have the market, where it's at, kind of the units it is, whether it's an older property and that's going to be renovated, or a newer property that doesn't need as much renovation. It's going to have a business plan that's going to say, here's how, when we acquire the property, what we're going to do. We're going to either increase revenues by rehabbing the units themselves and increasing the revenues, or we're going to add amenities. We're going to add a parking garage, and we're going to increase, rent the parking garages to people. We're going to have a tech package or something like that with smart locks and stuff like that. And we're going to increase the rents, because remember, the value is based upon the cash flow. So you either want to increase revenues or decrease expenses, or both. So you increase revenues by adding more line items and the units, and you decrease expenses by taking it over and having a new property management company that's going to maybe have fewer people on site, or has better contracts with vendors. And in there is going to be it's going to be the financial projections, as you said, for the next 5 years. They're usually all modeled on a 5-year basis. So we try to focus on giving people a 6 to 9% cash on cash return every year. So that means if you put $100,000 in, you get 6,000 to 9,000 back every year. And over the period of the 5-year estimated hold, that does vary. The investors would get anywhere between, if they put 100,000 in, they'd get anywhere between 185 and 200,000 back over the life of the 5 years. That's total return. So that calculates for the number of people out there about a 15, 16 minimum percent IRR. And so,
Can you explain IRR? Because that was the term that used to confuse me.
IRR is internal rate of return. And so I think the easiest way to explain that to the audience is, you're probably all familiar with compound interest. That's what you get at a bank, right? You get, I'll say 1% every year, what you do. And so it's easy to calculate. It's a 1% compounded rate. IRR is a number or a calculation that is, it calculates the return over a period of time of uneven cash flows. So all businesses do that. In year one, you're going to get a cash flow on that $100,000. I'll just say of $10,000. Next, you're going to get a cash flow of $5,000. And when it sells, you're going to get a cash flow of $150,000. So you can't use compounded interest. IRR is a number that evaluates the rate of return over a period of time with uneven cash flows, very simply.
So basically an average, if it's a 5-year period, it's kind of showing, based on the total return, this is what the average return was per year over the 5 years. If you break it out that way.
It's really a mathematical equation. It's not an average. It's not an average. It is a mathematical equation that you can Google it, or you can, if you're into spreadsheets, there's an IRR calculation. An average would just simply be, you got to, in that example, if you invest $100,000 and I gave you 200 back, $100,000 gain over 5 years, that's a 20% return. Well, the IRR is going to be probably even higher than that, because you got some of it early and you got some of it late.
Yep. And so on one of these deals, when in your case, you're putting together a group of investors, you've identified a property to go and purchase. The goal is to, come in and optimize however you've identified you can, whether that's doing renovations, upgrading units. Seems like in some cases, the good deals are just, they've been poorly managed, right? And they haven't increased rent in 5 or 6 years. So they're below, kind of market average. I mean, there's any number of ways that you're going to be able to, come in and add more value, increase revenue, and potentially even decrease costs. But the goal is to do all of that and then hold it for a certain period of time and then sell it or flip it to another group of investors. And that's when the majority of the return on the investment comes.
You're a wise man, Wes. Yes. And the thing, the difference is that about commercial real estate is, very few people hold commercial real estate for 30 years. There are some, but most of them are all at a max 10-year loans. So owners either have to sell or refinance. You're right. Mm-hmm. The first one I did in Beaumont is there was a group that had owned it literally for 20 years and I don't mean to be disrespectful, but they were fat, dumb, and happy. And they were sitting on a gold mine that we came in and just started raising rents and made a ton more money. Yeah. There are other times, like I want to find, I can reduce expenditures if I can find another property near one I already own. So maybe I own in Dallas and there's one a mile away. I can reduce expenses by that. Yeah. I can reduce expenses if I'm vertically integrated. If I, meaning I have my own property management company and I have my own construction company, et cetera, or working with people that do have those vertical integrations. I don't have those in my wheelhouse, but I work with people that do have those. So those are strong ways to increase cash flow as well. And data is a key one these days. You can get reports on any given property in America and the competition within the 1, 3, 5 mile radius. CoStar is a tool, and there are many other ones out there. So, big data affects us all. It's available.
how difficult is it to find good deals? Because, as you mentioned, there's, plenty of people out there putting together these types of syndications. I would stress that, just like I talk about all the time with investing in a franchise, not only do the numbers need to add up, but you need to know, like, and trust the people that are behind the brand that you're partnering with. So, that's a big component here too, right? Is establishing a relationship with someone like yourself, if you're going to be comfortable investing in these types of deals with them. But given the amount of attention these types of investments are getting and the number of groups out there looking for deals, because as you mentioned, it's not like I could go and find one of these apartment complexes for sale. Um, People like you that are on the inside and in the business are being made aware of these opportunities before they're, on the market, if you will. So how difficult is it to find good deals? Because I'm sure you look at deals pretty often and say, you know what, this doesn't have the characteristics that we feel would make a good investment, so we're going to pass on it. Has that gotten more difficult, or is there plenty of opportunity? You just need to know what to look for.
It surely has got a lot more difficult, and increases every year as there's many different organizations out there pushing out students. I run a separate coaching business on helping people find out how to identify properties to rent, and I mean to own.
Okay.
But that's a separate sideline. But anyhow, the answer is it's extremely difficult, and it is a totally unfair business because I'm going to get better looks than you're going to get if you're starting out.
Sure.
And there are people that are bigger than I am that are going to get better looks than I am because one, they have great debt relationships with the lenders and they have great broker relationships.
Yeah.
If I'm a broker who's incentivized to sell, right, a property, and who am I going to call? I'm going to call Joe, who's a first-time person that has never done this before, or I'm
Right.
going to call somebody that's experienced that I know can close the deal. And that's assuming that I or other people are interested in the deal, that we can underwrite it and it works for us, with some parameters. And with the rise in interest rates, that's really the challenge, is finding something that we call pencil, something that makes sense that, I can put my name behind. So, example, for me, it's different. Like last year, I did one that was here in Houston. It was a large deal with a big partner. We took down 600 doors, 3 different properties. But the peculiar thing about it was tax abated. So there was an affordable housing clause in the deal that if we leased to people with lesser income, we didn't have to necessarily lower rents, but we were tax abated. That meant that in Texas, real estate taxes reappraise every year. So we literally saved $2 million at close on expense line. Now, I don't have to be the brightest guy in the box to say that if I take out $2 million of expenses day one, this is going to be really good. Another example of I'm just looking at an asset that we're getting ready to go out to investors with right now. Is it's a build to rent property in Dallas. It's a different that industry is very favorable to me because of as you mentioned, the changing demographics, the nation of renters. Renters, because so much of the millennials have good incomes, but they don't have a balance sheet to buy a house. There's people of my age that want to get out of the burbs, and I don't want to do maintenance anymore. So, I'm seriously, my wife and I are talking probably in the next 5 to 7 years, I'm going to sell the house and find a place, a condo or an apartment to live in, so that I can just close the door and go travel if I want. So you have to become an investor versus a speculator. And an investor is somebody who understands the risk, knows what they're getting into, versus a speculator that's what I do when I put money in my 401k. I find a Fidelity fund that, it's a high growth, or it's a bond fund or whatever, blah, blah, blah. That's speculation to me anyhow, versus.
Yeah, I agree. I mean, I agree, unless your business is like day trading, right? Or you work on Wall Street and it's your business to constantly be analyzing all of these different stocks. But yeah, for the average investor, if you're putting money into the stock market, I mean, you have some data that you can look at to see previous performance, but you are speculating that it's going to do that. Whereas, as you've, I think, very rightly pointed out, if you're an expert and know what to look for, you're not really speculating at that point, especially
Yeah.
when there are levers that you can pull on to drive the outcome that you want.
Yep.
Right? I think that's another big distinguishment. Once I put money into the stock market, there's nothing I can do to determine what type of return I'm going to get on that money. Right? But if I own a
Yeah.
business, or in your case, if you're putting these deals together, then there are things you can proactively do to drive the type of results that you want. I like the point that you brought up around the difference between an investor and a speculator. And I think the other distinguishment there is that when you're putting money into just the stock market, you're speculating. There's also nothing you can really do after that money's in to impact the outcome, right? Whereas if you're investing, in your position, right? If you're putting a deal like this together, you know what to look for. There are levers that you can pull to, help to drive the outcome that you want for you and for your investors. If you're investing in a business, right? You are speculating to some extent, right? That it's the right business to be in, but there's going to be things that you as the business owner can do to drive better results and help ensure you get the outcome that you want. So I think that's an important distinguishment for people to make.
Yeah, and the other piece I'd add to that, Wes, is when I invest in a mutual fund through my 401k, I have no idea who the money manager is or where they live in New York City or whatever. When
Yeah.
you invest in a private placement offering, Randy or whoever you're investing through, where I live, my phone number. I get called a lot, frequently on any number of issues. And I think that's a big difference as well.
Hey everyone, we'll get right back to the episode, but I wanted to quickly share a free resource with you. If you're curious about franchise ownership and want to learn more about how countless people, including myself, have leveraged franchising as a way to create more freedom for themselves and to take control of their livelihood, I've put together an ebook. It's called Franchise Wealth Creation, and it's the perfect starting point for anyone that's just curious to learn more about this whole franchise thing and how I've helped hundreds of other people navigate all the steps involved in understanding and researching franchising. So click the link in the show notes, fill out a short form. I'll send you the ebook. I think it's a great starting point if you're curious at all about learning more about franchising. All right, let's get back to the episode. Yeah, well, that's a good point, and I know you invest your own money in all of these deals, and when we were chatting the other day, you told me that should be a red flag to anyone that's looking at investing in a syndication. If the general is a general partner, general is it partner? Yeah.
Yeah, the limited partner wants to ask the general partner those questions, or the
Right.
active
If the
person.
general partner is not investing their own money, that should be a red flag to anyone that's considering investing, which to me makes a ton of sense. So, man, there's so much more I could ask you about and pick your brain on. I know we're kind of running short on time here. So, in wrapping up, I'm curious what advice you would give to someone that's, wanting to learn more about real estate investing, maybe doesn't know where to get started. Maybe it's not quite in a financial place yet where they can go and invest into a syndication, because I think most of them require a, 50, if not $100,000 minimum investment. So where would you recommend someone start just to start learning? And I think investing is like most things. You kind of at some point just need to start taking action and learning by doing, at least to some extent.
Well, I think you hit it on the head. So, I'd be the classic risk adverse investor, and I would say that I grew up with the paradigm of investing in the stock market, and I think that at a minimum, everybody no matter where you're at, should really consider real estate from a diversification perspective in your portfolio. Whether you want to do single family flips, or you want to do a bed and breakfast, or a Airbnb, or anything in there, or a passive investment. I mean, the most simplest way for a person to get in real estate is to join a REIT, a mutual fund REIT. I don't like them, but if somebody wants some diversification there, that's one venue. I would say really then, as you said, you got to get started at some point. You may not have $50,000, but I got in my first one, my hand shaking writing the check, but I got in it with using my self-directed IRA. I used some of my corporate money.
Yeah.
That's an avenue people, and I did it with a partner, so I didn't have to come up with $50,000. We formed a trust, and each put in 25. Was the way I did my very first investment. And so there are other avenues. Happy to talk about it offline, but you hit it on the head. It's sooner or later, it's diversification and get started.
Yeah. Yeah. And like I said, so much else I want to ask you about. Why do you not like REITs? You mentioned I forget the terminology you use, but basically industrial warehousing investments. That's something I'm very interested in because I absolutely see the demand for it. So we'll have you back on for round 2 at some point. How does that sound?
That sounds fantastic, Wes. I'd love to continue the conversation. I really, really appreciate your time and your audience listening to me babble for a while. So thanks so much.
Hey, likewise, it's been very informative. And, I think your story too, of just how you navigated transitioning from corporate America into, being out on your own, and were able to do it in a smart and intentional way that, didn't result in you having to make this scary, difficult decision of, hey, do I jump or do I stay?
Yeah.
Because you were smart and intentional and calculating, you were able to make that what sounds like a pretty smooth transition. So I think that's probably encouraging for a lot of people to hear. Where should people go if they want to connect with you, if they want to learn more about InvestArk and the types of deals that you're putting together?
Well, Wes, thanks again so much. The easiest way to get a hold of me, there's 2 venues. I mentioned my webpage. I'm on all social media, LinkedIn, Facebook. We'll put it in the show notes. My webpage is invest-ark, A-R-K, invest-ark.com. There's a contact me page there. There's another one that I have, a coaching business. I said multifamilymaestros.com. Book a discovery call in there. I'd love to talk to anybody. Look, I'm not selling anything. I'm just trying to help people get further down their journey than where I was 10 years ago.
Yeah, I love it. Well, hey, man, it's been very, very insightful for me. I have no doubt that the audience will feel the same, and a lot of good takeaways here. So appreciate what you're doing. Appreciate you taking time to drop in here on the Path to Freedom podcast. And everyone go check out the website. I know Randy's got a mailing list that you can sign up for, so you can get notified when he's got deal opportunities coming down the pipe.
Thanks, Wes.
You got it. Thanks, Randy.